Businesses often conduct activities within multiple distinct entities for a variety of reasons. For example, to protect a low-risk business activity, the shareholders of a closely held corporation might form a separate corporation to conduct a different high-risk activity. The taxation of multiple corporations under common shareholder control is fairly complex, especially after the Tax Cuts and Jobs Act of 2017. As such, the discussion that follows will only summarize some of the concepts behind tax provisions that treat related corporations as a single reporting unit. The members of a related group of corporations are subject to special tax rules. If these rules did not exist, shareholders could obtain substantial tax benefits by allocating corporate income across two or more corporate entities to take advantage of lower marginal tax rates and other benefits. Although this issue was particularly important before the enactment of a flat 21% corporate tax rate, it is still relevant in the context of foreign jurisdictions, property transactions, and depreciation, as well as some tax credits. For example, for tax years beginning before 2018, special rules limited the amount of taxable income a controlled group of corporations could have in the tax brackets below 35% to the amount the corporations would have if they were a single corporation. After 2017, other provisions restrict certain depreciation deductions and the recognition of losses from property dispositions among members of a controlled group. So what is a controlled group of corporations? It is when two or more corporations are owned, either directly or indirectly, by the same shareholder or group of shareholders. Controlled groups fall into three categories: parent-subsidiary controlled group, brother-sister controlled group, and a combined controlled group. The formal definitions of these categories are beyond the scope of this course, but because the parent-subsidiary control group is common in practice, we can highlight some of its key features. The specific type of controlled group exists when one corporation owns at least 80% of the voting power or stock value of another corporation on the last day of the tax year. Multiple tiers of subsidiaries and ownership are permitted, provided the group has a distinguishable parent corporation. To illustrate, assume Illini Inc. owns 80% of the voting stock of Gator Inc., and Gator Inc. owns 80% of the voting stock of Orange and Blue Corporation. The three entities constitute a controlled group in which Illini is the parent, and Gator and Orange and Blue are subsidiaries. An affiliated group is similar but not identical to the categories of control groups just mentioned. More specifically, an affiliated group exists when one corporation owns at least 80% of the voting power and at least 80% of the stock value of another corporation. Recall that the parent-subsidiary control group definition only required one of these conditions, not both. Affiliated groups can elect to file a single consolidated income tax return. Consolidation is based on the idea that some groups of corporations are effectively a single taxable entity, despite the existence of other separate legal entities. By filing a consolidated tax return, the corporation can eliminate intercompany profits and losses based on the idea that its tax liability should be based on transactions rather than intragroup affairs. Consolidation also generally permits the losses of one group member to offset the income of other members. The consolidation process and related tax laws are complex, however, and often impose additional administrative and compliance costs on taxpayers.